Hi, it's David Bromley here. So I'm just going to wrap up these follow-up videos to the Winner's Edge series now and talk a bit about step 3 of best trading practice. You remember that I said that step 3 was the big one. It was allowing compound growth to deliver your fortune. And this is a situation where the trader is actually able to do something that the casino can't do. The casino, we know, has a mathematical advantage, but it's reactive. All it does is it covers the bets of the customer, and it does pretty well doing it. But with using step 3 and allowing compound growth to deliver our fortune, what we're able to do as system traders is to use money management and the second job of money management. And if you remember from the previous video when we talked about introducing a money management element into a complete trading system, it does 2 jobs. The first one is it manages your risk, but the second one is it simultaneously allows you to maximise your reward. So by sizing positions according to your evolving capital balance, you'll not only manage your risk, but you also give yourself the maximum chance to benefit. And I'm going to give you a quick example now of a couple of tests that I ran using my own stock trading system over the last 20 years. And the first test was a test using just a basic money management method. So I instructed the testing software just to buy the same number of shares for each trade, 2,000 shares. So I ran the system, and I'm going to here's the results of the system. Not bad results in many ways. It took a starting balance of 100,000, placed 243 trades, returned just over 12% compound annual growth, and turned the 100,000 in the 20-year period into just over $1 million. Now, you could look at this and say it's better than doing a lot of things you could have done with your money. This particular way of trading would tend to have undertraded or overtraded at the beginning when it only had 100,000 in the pot compared to what it had at the end, and it was buying the same number of shares. So in the beginning it was overtrading, and then gradually as the account built up it would have been undertrading. So this wouldn't have been a particularly smart way to work. In the second test, I kept everything about the system exactly the same. The same way of selecting the stocks to trade, the same way of entering the market and exiting the market, the same starting balance, the same broker's fees, tax, costs of trading, everything was identical, except the one thing I changed was in the money management element. I said, don't buy just the same number of stocks, but position my trades such that I risk 1.5% of my capital balance, whatever it is at the time of the trade, on each trade. So I used a fixed fractional money management method. And as the balance fluctuated, the risk fluctuated, but it kept this 1.5% ratio. So here are the test results for the second method of using the fixed fractional. You can see it starts with 100,000. You can see that it places a similar number of trades, 258 trades. But then when we start looking at the growth, this is obviously the thing that jumps out. We see that this compound annual growth rate has more than doubled to just over 26%. And the effect of this is enormous. And this is what I mean by really turning a system with an edge into eye-watering profits. Relatively speaking, you've got over 10 million in profits here, 10 times what you had with the basic money manager. So everything was the same. Our way of trading hadn't changed at all. The only thing we did was sized our positions in accordance with this different money management approach. And there we are, a 10 times reward. Now, the thing I want to say about this, the obvious thing that jumps out and hits you between the eyes is when you do this, you make a fortune. You make a lot more money by doing it. That's the obvious thing. But there's another thing that's going on, and it's just as important. When you use fixed fractional money management, what I haven't showed you is the second test, not only did it make a lot more money, but the risk it took to make that money, in this case measured by using the maximum drawdown that it suffered over that 20 years, was not much more than half what it took to get the million in the first method. So not only was it doing enormously better in the terms of reward, but it slashed the risk in half as well, nearly. So the effect of this is absolutely vital, because as you run your tests, so you can change the level of risk that you want to apply. And you can see the effects. You can see the individual trades. You can see the way that your account is fluctuating. And you can adopt a level of risk that you're comfortable, as you, the system trader, you're comfortable with. And this level of comfort leads on to a level of confidence that many traders complain that they struggle with. I've struggled with in my trading career. I don't know anybody who hasn't. That when things are not going well, then you start to look for reasons why you maybe have not done your work properly, or you start second guessing the system. But with this level of risk pegged at a level that you've been comfortable with, and you've been able to open the lid and look at the trades and look at what's really going on, that brings a level of confidence that is going to increase your chances of sticking with your system many-fold. And the reason why most traders fail, or one of the big reasons why most traders fail, even good traders, is that they don't stick to their system. So this is perhaps not the most obvious side effect, but it's a really, really important reason to use this method of managing your money. So I hope this has given you more of an insight into the sort of concepts that I've been talking about. I think it wraps up the series of the Winner's Edge, and it wraps up the third step of best trading practice. So thanks again for your time, and I'll be talking to you again soon.